China last Wednesday announced sweeping changes to testing and quarantine rules, aligning with a world that has largely reopened, after historic protests against mass lockdowns that caused mental strain for millions but kept the virus in check. The elation that met those changes has quickly faded amid mounting signs that China may pay a price for shielding a population that lacks herd immunity and has low vaccination rates among the elderly. It's always very difficult for any country coming out of a situation where you've had very, very tight controls, whose spokesperson Margaret Harris told a press briefing in Geneva on Tuesday, adding that China faced a very tough and difficult time. The WHO typically refrains from commenting on individual countries' policies, although Agency Director General Tedros Adhanom Ghebreyesus did say in May that China's previous COVID regime was not sustainable. Official COVID case counts in China have been trending lower in recent weeks. But that has coincided with a drop in testing and is increasingly at odds with the situation on the ground. There were 50 severe and critical cases in hospitals in Beijing, most of whom have underlying health conditions, state news agency Xinhua reported late Tuesday. Such numbers are small considering China's 1.4 billion population. But there are growing fears that this was just the start of the next wave. China has not reported any COVID-related deaths since December 3, before the country started the loosening of curbs. "This is the price we pay for being freer," a 26-year-old surnamed Liu who works in marketing told Reuters on the streets of the capital. "Now it is essential that we improve our awareness in self-protection. I think now the risk depends on individuals," she added, requesting anonymity. Long queues outside fever clinics, buildings attached to hospitals that screen for infectious diseases in mainland China, have been a common sight in Beijing and other cities in recent days. In Shanghai, China's most populous city, at least 7 schools have said they will stop in-person teaching due to COVID cases, with classes going online, according to parents and notices seen by Reuters. Infections are expected to spread across the country in coming weeks, as some people who have not been able to travel return to hometowns and villages. State media reports on Wednesday said daily traffic flows at the main railway station in the tech hub of Hangzhou had more than doubled to 128,000 as young people headed home. The mass movement of people will peak going into the Lunar New Year holidays, which start on January 22, after restrictions on domestic travel for the previous 3 years. The National Health Commission said it would roll out the second COVID-19 vaccine booster shots for high-risk groups and elderly people over 60 years old. It also said it would stop reporting new asymptomatic COVID-19 infections as many no longer participate in testing. Top Chinese health officials have downplayed the threat of the disease and pushed the idea of self-care in recent weeks, a dramatic U-turn from previous messages that the virus had to be eliminated. But amid growing concern about the virus spread, Chinese leaders have reportedly delayed a key economic policy meeting, which had been set to map out much-needed stimulus for the world's second-largest economy. A Bloomberg News report on Tuesday night, citing people familiar with the matter, said the meeting had been delayed and there was no timetable for rescheduling. Policy insiders and business analysts said the leadership was expected to map out further stimulus steps and discuss growth targets in the annual 3-day session. Economists estimate that China's growth has slowed to around 3% this year, far below the official target of around 5.5%, marking one of the worst performances in almost half a century. The International Monetary Fund warned in November of a possible downgrade to China's GDP. Its chief Kristalina Georgieva said that was now very likely after a recent COVID-19 surge, AFP news agency reported on Tuesday. China's yuan, on track for its worst year since 1994, when China unified the official and market exchange rates, eased against the dollar on Wednesday, with traders also citing worries about a fresh surge of infections.
European Central Bank set for 50 basis point rate hike on hopes that inflation has peaked. The European Central Bank will continue to hike benchmark rates, albeit at a slower pace, with inflation expected to be close to a peak and the Frankfurt institution looking to reduce its vast holdings of government bonds. We expect the ECB to raise its policy rates by 50 BP at the December meeting, said Michael Schumacher, an ECB watcher with Natixis, in a recent research note. We also expect an announcement of quantitative tightening next year, though the ECB is unlikely to provide a specific start date at this point. Quantitative tightening, or QT, could see the ECB shrink its gigantic bond portfolio sitting on its balance sheet after years of government debt purchases and monetary stimulus. The governors' meeting should be an opportunity to discuss the reduction of the balance sheet, Frank Dixmuir, a global CIO for fixed income at Allianz Global Investors, said in a note. We expect the ECB to take a very gradual approach to avoid market volatility shocks, as the governor of the Banque de France, François Villeroy de Galhau, recently stressed. Another hot topic for the ECB's Governing Council, which concludes its meeting Thursday with a press conference, will, of course, be inflation and possible peak inflation. While inflation likely peaked in October, we see core inflation lingering above 5% until mid-2023 before trending lower, said Anatoly Anenkov at Société Générale in a recent research note. And a lot of focus will also be on the staff projections, despite recent criticism about the reliability of the forecasting models used for them. It is widely expected that inflation expectations from the ECB will be revised upward for 2023 and GDP estimates should be lowered for next year. It will be particularly interesting to see whether the ECB will have a technical recession in its baseline forecast, Anenkov added.
Binance withdrawals jumped to $3 billion in 24 hours, research firm says. Investors withdrew as much as $3 billion from Binance on Tuesday, according to blockchain analytics firm Nansen, as the world's largest cryptocurrency exchange confronted investor jitters amid a deluge of negative headlines about the industry. Andrew Thurman, content lead for Nansen, told CNN that at its peak, Binance saw as high as $3 billion in net outflows over a 24-hour basis. A report about an ongoing investigation by the U.S. Justice Department into the exchange was a factor in investors' nervousness, he said. Concurrently, a large market maker, Jump, was found to have withdrawn huge sums from Binance with no deposits over the past few weeks, ultimately seems to have caused jitters among both retail and institutional users, Thurman said. In short, it's a lot of money headed out, and that spooked some folks. Earlier Tuesday, Binance had already seen its highest daily withdrawal since June, according to Nansen's analysis. The rate of withdrawals has since stabilized to approximately $79 million in net outflows, the firm's data showed as of Tuesday evening ET. Investors in the industry, already grappling with the crypto winter, sparked by the collapse of Terraform Labs in May, is dealing with a huge blow from the fall of crypto exchange FTX, which declared bankruptcy in November. Sam Bankman-Fried, the founder of FTX, was arrested in the Bahamas this week after U.S. prosecutors filed criminal charges against him. Binance was also in the headlines. On Monday, Reuters reported, citing unidentified sources, that U.S. prosecutors were considering wrapping up a money laundering investigation into Binance by filing criminal charges against individual executives including founder Changpeng Zhao. The U.S. Department of Justice did not immediately respond to a request for comment outside U.S. business hours. In a statement to CNN, Binance said that, as has been reported widely, regulators are doing a sweeping review of every crypto company. This nascent industry has grown quickly, and Binance has shown its commitment to security and compliance through large investments in our team as well as the tools and technology we use to detect and deter illicit activity, a spokesperson added. Zhao acknowledged the outflow situation on Tuesday, tweeting that Binance had at one point seen some withdrawals of roughly $1.1 billion. "We have seen this before. Some days we have net withdrawals. Some days we have net deposits. Business as usual for us," he wrote. In his Twitter post, the billionaire sought to strike a sanguine note, suggesting that it was a good idea for each crypto exchange to generally face stress test withdrawals. He later added that Tuesday's outflows were not among the highest the company had processed. In a statement to CNN, Binance added, "User assets at Binance are all backed one-to-one and Binance's capital structure is debt-free." Binance had initially offered to help bail out smaller rival FTX, before pulling out of the deal last month. On Tuesday, Bankman-Fried was indicted in the United States on 8 criminal charges including wire fraud and conspiracy. Separately, U.S. markets regulators also charged Bankman-Fried with defrauding investors and customers. Known as SBF, Bankman-Fried is a crypto celebrity who became a pariah overnight as his company suffered a liquidity crisis and filed for bankruptcy last month, leaving at least 1 million depositors unable to access their funds.